Boy, what a day. Big eventful news morning and weekend with the presumptive presidential election result, as well as vaccine news coming out early this morning. Really tore the markets up to the upside right at the open, and even more before the open. Started a little bit of a pullback there, but then how did we finish the day? So that's what's really important, a lot more important than how we open. So I'm going to break that down, especially in some of these different indexes, and what that means now going forward. Did we get a good breakout, a good breakaway gap here today? Nice, beautiful gap when we were opening up. How did we close, and what does it mean? So that's going to be the topic of today's video, and then what didn't work today, and how can we trade that? That's going to be our trade idea. So let's go ahead and get started. Today is Monday, November the 9th, 2020. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we gapped up to the upside today, gapped through that 23% retracement level, or 78%, excuse me. Very good close, though we had a filled-in body, and a long upper shadow, which can be bearish. You can see we don't get very many long upper shadows at these levels, just because it's hard. It's hard to get long upper shadows unless you're moving to the downside, and even then you start to get long lower shadows. So it's a relatively bearish candlestick pattern, but it's only a one-day pattern. So now it's just a matter of how do we follow through tomorrow? Whether or not we continue, and the issue with that body being filled in, that means that we filled in some of the gap, which means this is probably not going to be a breakaway gap. I thought at the beginning of the day today, when we gapped up and worked our way up, that okay, we've got a breakaway gap here. We're breaking through resistance. We're getting above the 78% line. We're going to get some decent volume. It's not going to fill in, and then we filled in the gap, some of it. And so that kind of takes away the potential for a breakaway gap at that point. And you can see, dark green shading and green line still, but market sentiment still falling, which means it's right now kind of easier for our path of least resistance is still down to the downside. The Dow is actually at a much bigger gap to the upside. But then you look at like the NASDAQ, and the NASDAQ had quite the bearish engulfing pattern. We gapped up, and then really, gap down through all of today's gap, and then some of this gap from earlier in the last week. So it would suggest there's a good chance we can keep filling in more of these gaps from last week, and of course not closing above the 78, not dropping this below 62 either. That would have been completely filling in the gap and then some, and obviously that didn't happen. On the other hand, the Russell 2000 finished very strong. So finishing up to new highs. Remember, it's already gotten above this high from early September, whereas the rest of the market hasn't been able to at least hold that close up above there. And so, you do have, it's a really good bullish candlestick, really good bullish pattern on the Russell, getting above multiple highs and going up to new highs. Really darn close to getting above its pre-COVID highs, and that's the issue right now for the Russell. You got a long upper shadow here. You're closing right at those pre-COVID highs. That's the significant. In fact, now we can activate this and just move this on up here. But that is the significant resistance now it's holding on to, is that 100% level of the pre-COVID move that we've had. So something to keep an eye on for the Russell tomorrow, again, as we follow through with today's move or not, is how we handle that pre-COVID high. And we actually, the 52-week high is a little bit higher than that on an intraday basis, about 10 points higher. But this is a very, very important resistance level. Just like on the S&P, this September high was an important resistance level that we were unable to hold the breakout above, and we'll see if that long upper shadow ends up being somewhat of an intraday type fake out pattern. So when you take a look at like the weekly chart, you can kind of see too Very, very bullish start to the week and a very bullish candle last week that really turned around this short-term sentiment, this bullish intermediate confirmation signal that we got from 2 weeks ago. So more than turned that around last week. Near-term lines back up. Now the question is, again, of course, how long can it stay up throughout the rest of this week, and whether or not we break down back below that 78% and turn that into a fake out pattern or not, right? Because that's, this is a great breakout up here to get above 78. It's a great breakout. But if we fill in the gap, the rest of the gap from this morning, tomorrow, and then some, then it's fake out, right? And it's just as bearish as that one was over here, and you can see the move that we had there. So considering where the NASDAQ is, that's kind of what I would expect would happen. But of course, on the other hand, you have the Russell 2000, which is just blowing up to new 52-week, or at least new year-to-date highs, if not 52-week highs. I actually did get an intraday 52-week high earlier before pulling back by the end of the day. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us there on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked our video today and that you want us to do another video again tomorrow. It's a quick way to give us feedback. If you don't like our videos, you don't have to click on anything. You don't even have to watch. But if you do like our videos and you want to let us know, hit that thumbs up. That's a big deal to us. YouTube sees that and promotes our video more, the more engagements that it has. So that's why we keep asking you for it. Also, while you're down there, comment. What did you get out of the video today? What stood out to you? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle there, at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, you can see some of these other things over here on the right-hand column, including our Market Outlook live video. So every day I do a Market Outlook video. I do a live video at 3:30 Eastern Time. We review all old trades. In fact, I even closed out a trade today from an old Market Outlook trade idea. So we do that, and I also put on today's trade idea before the market closes. So check that out there. All of our Plus and Premium subscribers get access to that. They also get access to all of our trading rooms. Here's all of our classes coming up over here on the right. Come down here, click on this heart that opens up a new window. Hit that like button right there. Also hit this thumbs up icon. It also opens up a new window. I invite you to click on that like button as well. Again, the more you do that, the more people will see our content because it has more engagements. You can see Twitter and Facebook doesn't promote content to all of our followers just because that's how their algorithms work. It also benefits you because they will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, now let's take a look at the weekly chart. And as we talked about last Friday, we started out the week with even with this kind of down at the end of the day, very strong bullish candle. And this, if we end up holding this kind of near the highs of the week by the end of the week, that's going to be about as bullish of a bullish candle as you could possibly get. Closing above all of these highs. As of right now, we're closing above a few of these. The September high will be, or excuse me, this early October high will be very important. That's the September high. Again, if we can close above that, that would be significantly bullish. Very strong candle, of course, higher close, no lower shadow. It would take a tremendous drop back below the pre-COVID highs for us to get a lower shadow. That would be 34.01, and right now we're trading at 35.05. So we're looking at more than 150-point drop if we end up getting it. Now we did drop quite a bit today from the high. The high of the day was 36.46 roughly, and we did drop down to 35.50. So we did drop 100 points intraday today. So 150 points is not out of the realm of possibility, of course. If we did do that, that would be another transition candle, which is kind of what we were expecting next week. So we'll see how that ends up happening. Remember, PPO is already very strong as it is. So hard to maintain a good lengthy intermediate run when PPO is not coming from relatively lower levels, when it's already at relatively strong to somewhat extreme levels. to the upside. Let's take a look at the 3 green arrow chart, and you can see obviously we got 3 green arrows. Big spike in volume today, no, not surprising. But you notice again, most of the volume today was bearish because we closed near the low of the day and well off the high of the day. So that kind of gives you an idea of how that kind of worked out there. If you look at the 2 line versions, MACD and stochastics are very strong, both crossing just a smidgen above their respective midpoints. But again, opening up so high and closing with a filled-in body like that is not the most bullish candle. Even though it's a bullish result, it's not red. It would be, if we were down, to be red, but it's not red there. The only example we really have going back here of a similar type move, but of course we were coming off a significant low point, was right there, and we didn't get the long upper shadow to go with it. But you can see once we closed above that high point a couple days later, then we held, so we were good. So keep that in mind. Closing above today's high, and as I said, with the long upper shadow on SPX and on the futures contract especially, if you look at the futures contract here, because a lot of trading occurred overnight, I mean there's a resistance up at that high point, 36.68 now. Closing above that would be a breakout. So not so much on SPY, right? Not so much, because by the time we opened up, we were filling in that gap to the downside. Let's take a look at how this impacted some of these other oscillators, like the RSI. It's above 60. You can see how it's above 60 there. We are above 100. So those are bullish results. But this is going to be the big one, is the DMI. And you can see we broke out strongly to 38, well up above that high. Not as strong as we had over here, but keep in mind that the EDX was really high. We were at the end of a run. To get a 38, to get this level of a move where the ADX was still down, to kind of give you an idea of what that looks like. The last time that happened, if you look at all this blue line here, which is the current level, we were kind of green there, and that ended up being kind of the parabolic move. You can see, let me zoom in on that so you can see it a little bit better. So we had gotten up to 40, and by the time we got to 40, the ADX had just barely crossed up above. And you can see that was the last time we had small caps really outperforming Qs, but over an extended period of time, not just a one-day period like this. To kind of give you an idea of what that looks like here, the NASDAQ relative to the IWM, that's today's drop right there. Tremendous drop. After flirting with the 50-day on Friday, we are for the first time below the 200 days since early, what would that be, about February, late February, early March of 2019 was the last time the Russell, the Qs were below the 200-day moving average of the relative strength line relative to IWM. So significant. So this move right here, we're not as low on an absolute basis, but we were still above the 200-day. That's that move in June. And so if you take a look and see, it was a big move, but it was more protracted of a move. So when you look at it here, that was the last time we had this big spike in the positive directional index before the ADX got above 200. And you have to go back for kind of a breakout pattern of that happening. You'd have to go all the way back out here. This would be October 2017. We kind of just went sideways here for a while as the ADX eventually did get up above 20 and got up above 25 and got dark green shading, and we actually culminated with that 2018. So we were just kind of starting an intermediate run, and we had been, if you see, we had been really lacking in trend for a few months going into that breakout move, right? That was kind of a breakout pattern on that particular case. If you look over here, that's not the case. We for a month we've been kind of sideways, but not for any length of time. We've had some pretty decent moves here, trending moves. So I don't know if necessarily we're getting a breakout type move on the DMI. I'm a little more concerned that it's looking more something like this, where you got this kind of parabolic move, especially on the IWM relative to the Qs. In this case, in one day, And considering how we started to fill in the gap, which means there's a good chance we fill in the rest of the gap, that suggests we might have that type of move more so than the one in the end of 2017 that led to like a 5-month-long intermediate rally that ended with that spike, parabolic spike in January of 2018. All right, so when you look at the intraday move here, speaking of gaps, right here, sorry. There's the gap from this morning. So it's like, it could have been a breakaway gap had we not started to fill in just about immediately. And we were kind of holding that low of the day late until, with this kind of volume gap below us until we broke through into that volume gap, which is typically what you expect. And now, you would expect us to fill in the rest of that gap there. And if that's not a breakaway or runaway gap, then it's more likely that these aren't either. And as I said before, the Qs have already started to fill in last week's gap. So that is last, what would that be, Thursday's gap, and then you got Wednesday's gap. So we've already started to fill in that one, breaking below Friday's low point at the end of the day. We'll see. We're a little bit up in the after hours, so we'll see if this holds. But I would prefer actually to be down in the after hours so we can fill in the bearish gap back with a bullish move to the upside. Gapping up again probably isn't the best thing to do because common gaps get filled. Obviously you saw the volume today, very significant, 171 million. The trading range obviously very significant too, when you include the gap here, 350.16. The low was 354, so you're adding on 4 more points, so more than double the ATR at 14, and then 171 million. So to put that into context here, 14 points is way up here, about as high as what we were in this area on an average basis at least. So way more than 2 times the ATR, and then the volume kicking in to 171 million is way up here. So you can see we're getting some upward moves here. That is not bullish, right? When those 2 lines are moving higher, that is more bearish. And when you get big moves, look at that big spike to the upside. That's a 2 standard deviation gap to the upside, and that includes some pretty significant gaps. The last time we had a 2 standard deviation gap with not a very big size move to finish was there in April. And you can see some of these others, they were all bullish, but they were all followed by some pretty decent bearish moves. So we keep an eye on that, especially with a very little small gap here to the upside, a small gap between these two. We'd have to really drop back down to like less than 7-point moves very quickly so that we can get those averages to stop going up for us to maintain bullishness. Otherwise, this is a bearish direction for both of these lines, and would suggest again some bigger moves to fill in some of these gaps. Otherwise, we hold with some smaller moves and we just start to grind, which is what we would all prefer, and start bringing these with lower volume and start bringing these lines down, which is more bullish. They don't have a whole lot of room to go down from here because they're not very high, but again, you can see the ATR in that June peak, that's about as high as it got, and the average volume was a little bit higher than here. So that kind of gives you an idea. We're at similar levels, and that's potentially the type of weakness we could get if we get any weakness coming out of this. Finally, the volatility index gapped way down here, gapped down to the downside. Didn't get below 20 yet, but then got down to the lower end again of the neutral range, but then closed on the other side of the neutral range. So with a pot with 3.5% gain on the SPX, even though we were up more than 1% on the SPX itself. So that's an interesting issue to keep an eye on too, to see what the follow through is. Again, breaking below 90% is going to be bullish, great. Breaking back above 95%, now we're back in bearish mode again, like giving some weakness, giving us some volatility, kind of like what we talked about in last Wednesday's market outlook. All right, so before we look at some other things here, just to summarize our technical outlook, It was a great open today, and it would have been a great breakaway gap had we held that open. But as you saw with like the Nasdaq, not only did we not hold the open, we didn't even hold Friday's low. And got a pretty significant engulfing pattern on the Nasdaq, and the beginnings of some gap fills from last week. That would suggest that might be the type of pattern we start to see in the S&P as well. Again, when you get such strong moves in IWM versus QQQ, you might get an update or two, and it seems like we've gotten like multiple updates all in one in that relative strength chart today. But that's usually not a good sign. That's usually more of a bearish sign going forward, because of how these cap-weighted indexes work, with all these large cap stocks dominating these indexes. So if they continue to lag, we would expect the markets to continue to lag too, relative to other more safe haven asset classes. So what do you think? Do you agree with that assessment? Do you disagree? Let me know with comments down below, especially if you disagree. Let me know what you're seeing that suggests why you're either a lot more bullish than I am, or why you're a lot more bearish than I am. What charts or indicators you're looking at, share with us down in the comment section down below. Alright, now let's take a look at what's driving this price action. Take a look at the 3-month chart here and look at emerging markets and small caps and the Qs. And I mean, this is a risk-on move. Developed markets. But let's just say that's over the last 3 months, of course. Let's just take a look at just today and how things opened up and then how they closed. So by the time we opened, REITs and small cap stocks just blew everybody away. I mean, they were up. The small cap stocks were up 7%. REITs were up over 10%. Now, granted, by the end of the day, those were the two best asset classes, but small caps were only up less than 4%. And you can see we went from a 10% gain to a 3.5% gain on the REITs. And developed markets continued their outperformance of the S&P, and emerging markets as well. And you can see there was strength in the dollar, and that put pressure on gold. Gold down 4% today, significant move down in gold. And you can also see a significant move there in bond prices. So bond yields making a big jump. If you take a look at bond yields here, breaking up above that 200-day moving average. Let me show you what it looks like here. There's today's move. Actually, from a Hakanyashi standpoint, there's today's move there. Big time breakout, up to 95 basis points, almost up to 100 basis points. That's significant. That's actually pretty darn bullish for risk appetite to be able to eventually get this golden crossover going on the 10-year yield. As we've been so bearish for so long, we've got a long ways to go to get up to that 0% mark still. So good sign there. And if you look at gold, on the other hand, I mean, look at this as we moved down, kind of broke down below some recent lows here. In fact, let me show you on the daily chart. There's this pretty tremendous evening star candlestick pattern. After it looked like we were breaking out of the retracement zone here on Thursday, and then kind of held those gains on Friday. Big time fake out today. So whenever you get fake outs, remember those tend to be more bearish than just coming down from resistance itself. So now we are at some recent lows. The question is whether we'll break those. You can see we got light pink shading. We already have a red line. We're still in the retracement zone, so we're not breaking down yet. And when you look at it on a Bollinger Band basis here, let's take a look at gold and Bollinger Bands. You can see this is a pretty significant support. If we can't hold this, there's a volume gap all the way down to 1730. That's bullish for the dollar. So when you look at the dollar index here, or the euro US dollar, excuse me, there we go, euro US dollar here, it doesn't have volume, but look at that engulfing pattern that we got. It's kind of hard to get an engulfing pattern on the euro US dollar. You can pretty much only get them on Mondays because of the gaps. That's when you can gap over the weekend. So it's rare, and that's pretty bearish. So bullish for the dollar, remember, is not necessarily bullish for equities. If we were to come back down into this little area here, back down towards this 23% retracement level, flirt with breaking it again, like we expect that we would on equities. Again, not the most bullish sign. So there is some elements here of some bearishness for risk appetite that we might have kind of had a little bit of a blow off today, blow off type top move with this move. You can see commodity or crude oil had a really good strong move today to the upside, only to hit up against some very strong resistance. So until crude oil can break through $40, getting up to 40 is great, but until you can break through 40 and really break through about 45, you've got a big major resistance up above, and you're in that 0 to 23% retracement level, which is a noisy period, and 35 is the low end of that, 45 being the upper end. So anytime, if we break one way or the other, that will kind of give us an idea in terms of risk appetite of where we can go from here. So great move today again, like last week. Bullish moves in some of these risk asset classes, but not breakout type moves. Let's take a look at how these other countries behave today. Some of these other really big economies. Look at the move in Japan. Look at the move in Germany, UK, France. Remember, these are the countries that are in lockdown right now. Italy, they're all doing very, very well. Everything moved up significantly, and gapped up tremendously, except for these Asian. Now, the Asians did well too, but it's not as well because they weren't as bearish as some of these other countries have been. All dark green lines across the board, all dark green shading across the board. So relatively bullish, pretty strongly bullish for everybody. Now the question is, can we hold these gaps? Or are we going to start to fill them in like we've already started to do, and with the S&P getting us that long upper shadow, are we going to start to fill these in which case there's some pretty sizable gaps to fill in on some of these indexes if we get kind of a buy the rumor, sell the news type of pattern here, where a lot of people have been looking for this vaccine. It hardly came out of nowhere today. A lot of people have been expecting some results here pretty soon. We got the results now. Now, do we sell the news? And that's going to be an interesting thing to see for the rest of this week going forward from here. Big move higher today in industrials, materials. In fact, if I were to look at the biggest winners in the S&P 500 today, here, let's get to the S&P 500. If I were to get to the biggest winners today, let's see, give it a second to load up here. For some reason, I got a bunch of different type of, here we go. Carnival Cruise Lines, energy stocks, there's your real estate stocks, hotels, REITs included in there, some more Carnival Cruise, wind properties, more energy companies, retailers like Nordstrom's, which have been beaten up, financials, there's a regional financials here in my neck of the woods, Zions Bank Corp. So, these aren't the most bullish stocks. Obviously, they are kind of the lower end of stocks. And if you take a look at the sector performance here just today alone, again, to see how did we open and how did we finish relative to each other here. And then we'll go to 5 minutes here. You can see energy opened up strong and stayed strong. Financials opened up strong, held most of those gains. Real estate we saw come down, and industrials we saw come down, as well as some of these other stocks. And look at the very bottom. These were the biggest losers today. Technology, communication services, consumer discretionary, and you see some staples there too. And healthcare, remember, is kind of one of those big sectors as well. You notice that we had 2, 3, 8, 14% gains. If this were XLK and XLY, SPY would be up here. But because those sectors are down, so is the SPY. And so, again, it's not a good thing for these sectors to be the big losers, to be the big underperformers. And that continues to be the case. If we continue to see more of a pattern of weakness here, then that's not a good sign. If we bounce off this 200-day moving average and start working our way back up, we stop filling in this gap and the Qs kind of take the lead and go forward upward from here, great. Then we're bullish, we're holding on, we're starting a new run. But if not, if we kind of break down a little bit here, if we don't want to break down too much, but if we break down significantly here, that's, now we're talking like, we could get into a market sentiment pullback and more bearishness. That's unlikely, right? I think that's pretty unlikely. So I think if we're going to be bullish going forward from here without any more weakness, that's like we have been expecting as of last week, filling in these gaps from last week and so forth. If that's going to be the case, these sectors here need to be on top and outperform and lead us back up. And there's a good chance that can happen as soon as tomorrow with how that, with sitting on that 200-day moving average on that relative strength. Otherwise, if we kind of float around with that relative strength line, then expect more weakness from a broader market standpoint. Not fall off a cliff weakness, just more consolidating weakness like we've had for the past month before we eventually can break ourselves back out and really get going again. I think last week made it look like we're trying to break out, but I don't think we're there yet. And today's move was great, but obviously the fact that we couldn't hold a lot of it means we might not be quite there yet, especially with the leadership of that breakout. All right, that brings us to our trade idea of the day. And one of the stocks that really benefited well during the stay-at-home trade was Tractor Supply. And this was a trade we had in one of our trading rooms, a trend trade where we bought on that, on this kind of breakout overbought cluster, and we rode this trend up until we closed it out over here. Very good trade, did very, very well for us in our class. We bought a long call option with it. Well, now things have turned around, and now today's move you can see is a big move back down, kind of breaking through some oversold cluster lows, dark pink shading again with a red line. If you take a look at the 3 green arrow chart for Tractor Supply, we had a couple of green arrows, but we didn't quite get the third, and we got kind of a light pink shading yellow line pattern, and now we're rolling back over some very strong volume, 3 red arrows again. If you take a look at the 2-line versions of this chart, you can see the 8 and 17-day moving averages all falling, all in order in a bearish order. You take a look at some of these other oscillators here. You can see back below 40, back below negative 100 on these. If you look at the DMI for Tractor Supply, the negative index almost above 30, positive easily still below 20. So bearish patterns across the board. If you take a look at the long-term crossover chart, we're basically just filling in this gap from the 50 to 200 and potentially testing that 200-day moving average, which we haven't done yet after the golden cross. So something similar to this right here, getting a golden cross and then a test. So we're kind of in test mode of that 200-day moving average with some downside to go, especially because we moved up so far so fast. Not very much volume here below us. So very easy for us to come down towards this 116 area, which is 1 standard deviation in December. So what we did is we bought a put. We bought a 125 put for December. We sold a 120 put to help cover the cost. Did a few contracts here to keep our position at half of what we normally risk, and getting about a 4-to-1 in the worst case scenario, 4-to-1 risk reward ratio. If it works out, you can see we're already up a little bit since we got into the trade at right around 3:30 Eastern time. Which is the benefit of watching the Market Outlook live, because you can see it now instead of seeing what will happen tomorrow morning. But regardless, it's kind of a bearish pattern that we're kind of follow to see if this work from home trade sells off a little bit to the tune of, and starts filling in some of those, especially some of those volume gaps like we saw in Tractor Supply that are so prevalent across a lot of those stocks because they moved up so far so fast without building good bases of support along the way. All right, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums on our Market Scholars website. Anybody can post there, as long as you're even a free subscribers can post in that forum. Post any questions, any comments you have, reply to other people's threads, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, as well as on Twitter and Facebook too, and comment on our videos. Have a great rest of your Monday, everybody, Monday night, and we'll see you all next time.